John Higgins, Mortgage One. Happy Monday. So, big week coming up as far as interest rates go. Tomorrow we have the Consumer Price Index. This will be a reading on inflation for the consumer, both the core and the headline number, followed immediately by the Fed meeting on Wednesday. So we're a bit range bound here, and it has been at somewhat elevated levels as far as interest rates go. So, everything really comes down to that inflation number, immediately followed by the words that the Fed will have to say in their statement. And we'll get an indication if there's going to be a pause or not. 25% chance that the Fed actually raises rates this meeting, so it's not likely. Although, if you read some of the commentary on some of the pundits out there, as far as the interest rate environment goes, where a month ago maybe we were talking about this being the end of this rate increase cycle, now they're saying that maybe the Fed will pause. And some things that are contributing to that, we are in a global society, so what happens around the world oftentimes has impact here. So surprisingly, the Bank of Canada raised rates last week. That put a bit of a pause in some of the Fed speech as far as stopping with the rate increases. And then inflation overseas, especially in the UK, continues to be a problem. And as we said before, inflation is the number one enemy of lower interest rates. And until the Fed gets a real good handle on inflation and sees those numbers dropping back towards the 2% number that they desire, we're kind of sitting on pins and needles to see what the Fed says. So, watch what that number comes out tomorrow. If that is a number that comes in below expectations, that'd be fantastic for the economy and, more importantly, our mortgage interest rates. And then watch what the Fed has to say on Wednesday. If there's more talk about a longer pause and maybe stopping, that also would be great. If the language that the Fed releases, if they don't raise rates, still keeps potential rate increases on the table as we head through the rest of this year, that could be a bit of a negative for rates. And as we look at the economy as a whole, it continues to move along at a nice pace. That's great for us. We need people with jobs and a somewhat robust economy to keep the housing market moving. But what it's doing is it's creating a little bit of a floor, and rates cannot get below this 6.5% range right now. And until we do see rates go lower, honestly, there's not going to be a lot of inventory come to the market. Sellers are going to be unwilling to trade in these rates that they picked up in 2020 and 2021 and pick up a rate that's 6.5% to 7% here in the year 2023. So we'll see what happens with the Fed. It is a big week, so stay tuned, watch the headlines. Of course, give me a call with any questions. Have a great week, and we'll give you the results of the Fed meeting next week's call.